Hi, everybody. This week's lecture is on the complements to NPV. So we know NPV, we're going to complement it. We're going to make it complete, try to round out some of the edges and fill in some of the holes, the incompleteness of the net present value rule that we have encountered so far. To do that, we're first going to remind ourselves why we like the NPV rule so much. What is it doing? We're going to introduce something, sounds kind of fancy, but it's very simple. It's called the Fisher separation theorem. The Fisher separation theorem is going to tell us that under certain assumptions, all we need to do as like a CFO or a CEO of a company, all we need to do is maximize NPV. That's really our only job. If we do that, that's going to be the best thing for our investors. That's, the fancy name is the Fisher separation theorem. We'll discuss that. Then we'll start to break down those assumptions. Okay, we're going to talk about when is the NPV going to need extra help? When is it going to need to be complemented by some other stuff? The punchline is NPV works very well when financial markets work very well. Another way to say that is if it's easy to buy and sell at a fair price, if it's easy to buy and sell stock, or if it's easy to get a loan at a fair price, then financial markets work well. If financial markets are working well, then NPV is going to be the only thing we need. There are times, however, when financial markets do not work well. So we want to discuss that, because if it's not easy to sell equity or to get a loan at a fair price, then NPV is going to have some shortcomings. So we're going to walk through situations where NPV is not quite enough and we need to complement it. And then we'll discuss other metrics people use when they combine these metrics with NPV to try to give a fuller picture of a project. We'll talk about the payback period rule, the average accounting return, the internal rate of return, the IRR, we've alluded to this before, and the profitability index. Okay, so all of these are trying to complete the picture a bit that NPV misses some things. And then finally, we'll spend the last couple slides talking about how CFOs actually make decisions. They're going to use NPV a lot, but they are also going to be using these extra metrics, and we'll talk about why. So first things first, we're going to motivate the NPV. We've already done this quite a bit with the present value lecture, so this is a bit of a review. Why do we like the NPV rule so much? In the present value lecture, we said that the NPV is so powerful because it lets you compare anything. Any investments that you want, something as exciting as SpaceX or something as boring as Dunder Mifflin paper, you can compare those on an apples-to-apples basis, which is pretty amazing. All you need are those three ingredients for NPV. You need the cash flow, the discount rate, and the timing of the cash flows. If you can pin down those ingredients for a Dunder Mifflin cash flow, and you can pin down those ingredients for a SpaceX cash flow, then you can compare them and say which is worth more to you. Okay, so that's the power of NPV. We get this apples-to-apples comparison. That leads us to something called the Fisher separation theorem. If you're managing a firm, so if you're a CFO or a CEO or you're anyone who's making a decision within the firm, this is your job. How do you meet the objectives of your investors? Right? They're kind of your bosses. The investors are the ones providing money for the company. You want to do what's best for them. What does the Fisher separation theorem tell us? It says that all you have to do is maximize NPV. Basically, just take the NPV rule and you just keep applying it over and over and over again. It's almost robotic, right? If you have a project, does it have positive NPV? If yes, take the project. If not, then don't take the project. Right? Just kind of this very simple, just brute force application of the NPV rule. That's the best thing for your investors, because by taking all these NPV positive projects, you're going to be increasing the wealth for your investors, and that's the best thing that they can do. So there's a bit of elegance here. You only have one job. You have one thing to do, just maximize NPV. It's very simple. The best way to see this is with an example. So let's talk about time. So pretend, for example, that you are, say, the CFO of Time Incorporated, right? So they have this magazine. We're going to set up the baseline cash flows here. Okay, so a very simple company, just to illustrate ideas. This whole lecture is really conceptual, right? There's not a whole lot of computation here, dotting I's, crossing T's. We're just going to have some stories today. story time. So this is the first story trying to illustrate the Fisher separation theorem. So pretend you're the CFO of Time Incorporated. These are the cash flows that you expect. You're expecting to get $45 million at the end of this year, and then say 90 million at the end of next year. After that, we're just going to say the firm ceases to exist. Keep things super simple. If we have a discount rate of 10%, then what is the value of these cash flows? Well, just like we always do, we're going to draw out the cash flows and discount them. So we just have two cash flows, 45 million in a year, 90 million in 2 years, discount them. So the present value of Time Incorporated is 115, say. Okay. Now, to make things a little bit more interesting, I'm going to introduce an alternative possibility. Okay. So suppose that Time could basically squander some goodwill that they have with their readers. So if they publish a series of kind of sensationalist stories, they're going to bump up their cash flows in the short term. Everyone wants to read the latest kind of gossip, latest sensational story. However, eventually people are going to realize that Time loses some credibility. You're going to lose subscriptions, and then your future cash flows are going to drop. Okay, so in this kind of made up example, you're going to generate $100 million at the end of this year, but then cash flows are going to drop to 5 million in 2 years as people start to kind of cancel their subscriptions. What would be the value of Time in that case? So this is a myopic strategy, right? You're pulling cash flows forward in time. You're getting an extra bump at time one. You get 100 at time one as opposed to the 45, which is the baseline. However, you're eating into your time two cash flow. So instead of getting 90 at time two, you're only getting 5 at time two. So you put these two things together and you get a total value for time of 95, okay, versus the baseline of 115. Okay, so I just wrote these over here in the table just so we have them as I introduce a wrinkle in the example on the next slide. Okay, so these are the cash flows, very simple, nothing complicated here. I want to illustrate the Fisher separation theorem with these cash flows. How am I going to do that? I'm going to introduce our investor. Right? The Fisher separation theorem is all about what's best for the investor. So suppose Jane Fonda is the only shareholder of Time. So Jane Fonda is an actress, a philanthropist, activist. She wants to donate 100 million to the UN next year. Assume that all the cash flows generated by Time are paid out as dividends. So if we go back to the cash flows over here, if you follow the baseline strategy, you'll get 45 million in cash flows at time one, 90 million in cash flows at time two, and you just pay those right out to your investors. In this case, that's just Jane Fonda. Okay. She wants to have 100 at time one so that she can make a big donation to the UN, okay, to save the rainforests. How can she do this? Now, if this were a live class, I would pause for a couple minutes, let students think about this. How can you look at these two possibilities over here, your baseline cash flows and your myopic project? You look at these two sets of cash flows and need to think of a way to make your boss, make your investor happy. Right? You're the CFO, Jane Fonda is your boss. She wants $100 million next year. How can you do that? Okay, so you can pause the video for a second, think about this. Okay, we're back. Now, what's tempting? Why did I add this extra myopic project here? We know it's a bad deal. The NPV is lower for the myopic project, the sensationalist stories. NPV is lower here than on the baseline. Well, it's a little bit tempting, isn't it? Because you know that your investor wants to have $100 million at time one. You can get that at time one if you follow this kind of short-term strategy, right? You kill your cash flows at time two, but you get more at time one, so maybe you can satisfy your investor that way. That's a trick, right? You don't want to do that. How else can you give Jane Fonda the $100 million at time one? Well, if financial markets are working well, said that's a key assumption of the Fisher separation theorem. If financial markets are working well, then you can sell stock or you can get a loan at a fair price. So what's one thing you could do? Say, let's say you take the baseline, so you're going to get these cash flows, $45 at time one, $90 at time two. You know that you're about $55 million short at time one. 100 minus 45, you're $55 million short. Okay, how can you raise $55 million for your investor? Well, you have to raise it using your time 2 cash flow. So what's one way you could do it? Well, you could sell some shares of your company at time 1. So how much would you need to sell? Well, if you're going to get 90 million at time 2 and you've got a discount rate of 10%, then that means the company's going to be worth about $81 at time 1. Just based on this time 2 cash flow, you pay the 45 to Jane Fonda, the company's still going to be worth about $81 after that. So you need to raise 55. So you'll sell about 2/3 of your company to other investors. Other investors are going to pay $55 for about a 2/3 stake in time. You take that extra money that you raised from equity investors and you give that to Jane Fonda. So now she's got the full 100 million that she wants. What happens at time 2? Well, Jane Fonda still owns 1/3 of the company. You sold off 2/3 to raise money for time 1. So about $60 at time 2 is going to go to those new investors, but the other 30 can still go to Jane Fonda. So that's a way where you haven't destroyed any value. You're keeping the value of the company at 115, but you're still allowing your investor to have the cash flows that she needs. Okay, this is much better for Jane Fonda than the myopic project, right? With the myopic project, you give her the $100 at time 1, and she only gets 5 at time 2. Whereas if you were able to sell equity at time 1, you could still give your investor 30 at time 2. Okay. So what are some other ways you could do this? Well, instead of raising equity, maybe you get a loan at time 1. You don't have to sell 2/3 of your equity. You could get a loan for 55. What's going to back that loan? Well, your investors are going to see that you've got, the bank's going to see that you've got $90 coming in at time 2. So they're happy to give you $55 at time 1 because you'll just pay that $55 off with interest, 10% based on this $90 time 2 cash flow. Okay. So in either case, either you sell equity or you get a loan, Jane Fonda is going to get the same outcome. She's going to have the $100 at time 1, and she'll have about $30 left over at time 2. Okay. But what's nice is that as the CFO, you don't even have to do any of this. You should put it out of your mind. I mean, you could do this if you wanted to kind of hold your investors' hands a little bit and make it easier for them, but you don't have to. Why not? Because your investors can do the same things that you can do. Under these assumptions that the financial markets are working well, you don't have to get a loan or sell equity. Your investor could do that. So that's what I have in these bullet points here. Jane Fonda herself could sell shares. Maybe she just sells everything at time 0 for $115. And then she knows that she'll have enough at time 1 to give the UN 100. Okay, she'll be left with about 29.5 million if she does that. She sells her shares and then she invests it at 10%, which she would have gotten anyways. So at the end of the day, she'll be left with 29.5 at time 2, and she'll have 100 at time 1. Okay. Or she could keep her shares. Maybe she doesn't get a loan. She keeps her shares till time 1, and then she gets a loan at time 1. She borrows the other 55 million at time 1 so that she can pay the UN, and then she pays off her loan. The investors pay off their loan based on the dividends that you pay them at time 2. Okay. Or they could do any kind of combination. You could do any combination of the loan and equity at yourself, or your investors could do some combination of selling equity and raising loans themselves. Okay, so there's basically an infinite number of ways that you or your investors can move these cash flows over time to make sure that your investors get them when they want. They can get the cash flow when they want. Okay. So in fact, you don't even need to worry about that. Just let the investors do it. Your only job is to maximize NPV. You take the best project, you take this first one with a present value of 115, and that's the best thing for your investors. So you as the CFO, you don't have to worry about your investors' need for cash. You don't need to worry about what your investors are going to do with the cash. You don't need to worry about this desire to save the rainforest, give money to the UN or whatever. Your job is simply to maximize the value of the company, and then you let your investors do whatever they want with it after that. Okay. You definitely do not want to destroy value. You don't want to take these myopic projects because that's actually going to be worse for your investors. Okay. In fact, the better you do at maximizing firm value, the more your investors can give to charity or to do whatever they want with it. That they have the freedom then to do whatever they want to do. Now we said there's some assumptions here. What had to be true for this to work? We said that the capital markets have to be working pretty well. So you have to be able to sell shares at a fair price or get a loan at a fair price, or your investors have to be able to do that. Okay? As long as that's true, then all you have to do as a CFO is maximize firm value. Okay. We're obviously going to talk about in a little bit what happens if financial markets are not working well, what else we can do. But for now, if financial markets are working well, you have no other problem. All you have to do is maximize NPV. Okay, so in this example, you had to sell shares or get a loan. All right, so that brings us to the bottom line of this kind of fancy sounding Fisher separation theorem. All you have to do is maximize NPV, and that's going to be the best thing for your investors. Now, there's a separate question. Maybe it's been bothering you a little bit. We've just been talking about things from the perspective of the investors a lot. Okay, so this is a bit of a debate. Whose company is it? Who should we be thinking about when we make decisions? The first view is that it's the investor's company. Investor interest should be given the first priority. And when we do NPV, that's the view we're taking, kind of implicitly. We're valuing things from the perspective of the investors when we calculate NPV. There's another view in this debate, though, which thinks about stakeholders more generally. So investors are one stakeholder, but a stakeholder is anyone who has a relationship with the company. So this would be workers, this would be suppliers. And workers are a type of supplier, they supply their labor, but other suppliers more generally. You can think about customers, you can think about the local community where the company is sitting. So this is another view that all stakeholders have some say in what happens to the company. And there's a bit of a middle road, third road. It says that the shareholders are the ones who are kind of in charge of things. They're calling the shots, but the shareholders are not all Scrooges, right? They're not all just trying to maximize cash for themselves. Shareholders care about stakeholders to some extent. Okay, so in this middle view, shareholders are still running things, but they're willing to sacrifice some value on behalf of the stakeholders. Okay, so I just want you to be aware of this debate. This is a debate about who is in charge, who kind of has ownership of the company. When we're doing NPV, we're definitely taking the view of the investor. One reason we're doing that is just because you can measure that pretty easily. We can calculate NPV, whereas these claims on the company, the customer's claims on the company, these are just much harder to think about. We don't have the same kind of analytical tools to think about that. So we are going to leave that aside. And then, as you progress in your career, you'll have to keep this in mind and work through this. But for now, we're taking the investor's perspective. There's a separate debate, kind of more general than that even, but what is the purpose of the firm? So again, when we do NPV, we're basically exclusively concerned with financial value. Okay? Other types of values are outside of our paradigm. So if you think about Chick-fil-A, right, they're closed on Sundays. You always forget about that. You want to go, but they're closed. Now, what can we do with NPV? Well, maybe we can measure that. We can say, if they were to open on Sundays, how much value could they create? That would be something you could feasibly do with NPV, but you could never say, well, they should open on Sundays or they should stay closed on Sundays, right? That's just completely outside of the realm of finance. So in short, taking these two things together, NPV is concerned with the investors and it's concerned with the financial value going to the investors. So you can kind of think of it, this is maybe a little bit harsh, but we're a bit like Scrooge, right? From Charles Dickens' A Christmas Carol, right? Scrooge doesn't care about anything else, just money, doesn't care about Christmas, doesn't care about charity. So here's the Muppets version of that.
I know how to treat the poor. My taxes go to pay for the prisons and the poorhouses. The homeless must go there.
But some would rather die.
If they'd rather die, then they'd better do it and decrease the surplus population.
Oh dear, oh dear, oh dear.
This is the door. You may use it.
All right, so that's a bit harsh, obviously, but that's what NPV is doing. You just care about the financial returns. Now, I like to be a little bit more charitable. I like to think of NPV more as Starbuck from Moby Dick. So you know the basic story of Moby Dick. They're going out hunting for a white whale, right? You got Captain Ahab. He's a little bit crazy, right? All he wants to do is find this whale that bit off his leg, and he's going to do anything it takes to hunt down the whale. Okay, so he's a bit deranged. His first mate, or whatever, Starbuck, he's much more practical. He wants to make money, right? He wants to find whales for their oil, sell the oil, make money, go back home. Okay, so let's watch that.
Captain, I'm here to hunt whales, not my commander's vengeance. How many barrels of oil will your vengeance yield? I ask you.
Oh, I see. Is money to be the measure of everything we do? Then let me tell you, my vengeance will fetch a great premium here.
So is money the measure, right? With NPV, money is the measure. So that would at least deter us from going on this crazed Captain Ahab path. Right, so is money to be the measure? Well, if yes, in certain circumstances, money is the measure, NPV is going to do a very good job. If money is not the measure, and if you've got some kind of higher objectives, well, you still care about NPV. You still care about your investors. Investors are still an important stakeholder, even if you are concerned with workers and with customers and with your community. You still obviously care about your investors and keeping them happy. Even if the financial gain is not the most important thing, it's still a very, very important thing. It's a very useful ingredient to know and to be able to pin down. And also, maybe most important is that, at least in the US, the investors have legal control over the firm. So investors decide who's a CEO, investors decide who is running, who's making the decisions, right? So in that case, you can't ignore it in for-profit companies. And then finally, as I alluded to earlier, NPV is something that can be measured, while other claims are a bit more abstract. And so you can at least pin it down. So that's kind of a good place to start to think about that. So we've talked about why we like NPV. NPV is a great way to measure the financial value that a project gives us. That's based on financial markets working well. So if financial markets are not working well, then NPV is not going to give us the best measure of financial value. We'll need to help NPV a little bit. We'll need to do some extra things to measure financial value if financial markets are not working well. So that's what we're going to talk about next. NPV needs help when one of these conditions are violated, right? So these 5 bullet points here, these are the requirements for a well-functioning market. These are what allow you to raise money at a fair price, or to get a loan at a fair price. So if these things hold, then NPV is great. If one of these things is violated, NPV needs some help. So what are these 5 things? Let's kind of enumerate them. First, there need to be no bankruptcy costs or financial distress costs. The assumption here is that if a company gets close to bankruptcy, or they go into bankruptcy, then they can continue to operate as they normally would. Bankruptcy itself doesn't destroy any value. If bankruptcy destroys value, then we run into problems. Okay, so the assumption that allows NPV to work is that there's no such costs of entering into bankruptcy. Okay. Next assumption is about private information. In particular, say the CFO or the CEO, they're not going to have private information about the firm that investors don't have. Okay. If this is true, if managers have private information that investors don't have, then it may be hard to raise money at a fair price. So NPV may not be enough. Okay. Likewise, there can't be any conflicts of interest between managers and investors. Right? That's what agency means. Managers are the agents of the investors. They're supposed to do what the investors want. So if there's a conflict of interest here, then managers may not want to do what the investors want them to do. And if that's the case, then again, it may not be so easy to raise money when you need it, and NPV may not work well. 4th point, investors can borrow and lend on their own account on the same terms as the firm. So when we talked about Jane Fonda, right, what did Jane do? She was taking a loan, or she was selling her shares just like the firm could. Right? So if the firm can get a loan to pay off a dividend at time 1, well, Jane Fonda could do the same thing. So if investors can't do that, then again, NPV may run into some problems, because Jane Fonda is not going to be able to get a loan when she needs it. And so therefore, NPV may not be enough. And then finally, we talk about markets being competitive and efficient with respect to public information. So what does this mean? This means that if you look at the stock market, the price of a company on the stock market should reflect the information that's out there. Okay? If the prices are noisy or if it's inefficient, then what that means is that the prices are wrong. And so if the prices are wrong, then you may have trouble raising money. Or say the price is too low for your stock and you want to raise money for a new project. Time wanted to raise money to pay to Jane Fonda. If the prices aren't correct, if the prices are too low for Time, then the company's going to be, it's going to be costly to raise money. You're going to be selling shares at too low of a price. And so that's costly for you and for your investors. And so NPV may not be all you need. Okay, so these are 5 basic types of assumptions that we need for financial markets to work well, for the NPV rule to work very well. So if these are violated, then we may need some other things to complement the NPV. So again, I'm going to just lay out some fables, just story time, trying to walk through these frictions. We call these things frictions. If these are violated, we say there's a friction in the financial market, if there's costs of bankruptcy, or if there's information problems. So these are all different types of frictions in raising money. So the first friction is private information. You can imagine that these assumptions are violated a lot to different degrees. The easiest way to think about the private information situation, so when does a manager have more information than the investors? Well, they probably have that a lot of time. The easiest way to fix ideas is to think about the used car market. Okay, so everyone knows that when you buy a used car, the seller knows a lot more than the buyer. So I lay out this situation here. I'm just going to show a table. Suppose you're looking to buy a used car. Say it's a Civic. It's a 10-year-old Civic or something like that. If you're the buyer, how much do you value the car? Well, if it's been maintained well, then say you value the car at $8,000. If it wasn't maintained very well, then you only value the car at $2,000. Right? You know that if the previous owner didn't maintain things, then you're going to have to pay for it later. You're going to have to pay for that maintenance that the previous owner skipped. Right? So because of that, if the car wasn't maintained well, you don't value the car very highly if it was not maintained. Think about things from the seller's perspective. Well, the seller has the same basic idea. If the seller maintained the car well, then they value it at, say, $6,000. If the seller didn't maintain the car very well, then they only value it at $1,000, right? So the seller still maintains, the seller values a car more if it was well maintained than if it was less well maintained, if it was poorly maintained. Okay. So looking at this table, in both situations, whether the car was maintained well or not, the buyer values the car more, right? The buyer values it at $8,000 if it was well maintained. The seller only values it at $6,000. So they should trade here. There should be some price between $6,000 and $8,000 where they can both be happy. Okay. Likewise, if the car was poorly maintained, the buyer still wants the car for $2,000. The seller's still happy to get rid of it for more than $1,000. So there still should be some gains to trade here. Here's the wrinkle. Here's where this private information shows up. Who knows whether the car was well maintained or whether the car was poorly maintained? Well, this is a classic example, though it's a market for lemons, right? The seller knows. The seller is the one who is doing all the maintenance. So the seller knows whether they skip some oil changes, or every car's got the scheduled maintenance in it. It's got a book with the scheduled maintenance when you should be doing tire rotations, the oil changes, and flushing the fluids, all that stuff, right? The seller knows whether he did that or not. The buyer doesn't really know. The seller knows all the weird quirks and all the things that need to be done with the car. The buyer is not going to have nearly as much information. Okay, so what is the buyer going to have to do? The buyer's going to have to guess. Maybe it was well maintained, maybe it was poorly maintained. Say the buyer guesses that there's a 50% chance that the car was well maintained, and there's a 50% chance that the car was poorly maintained. Well, what does that mean? Well, the buyer values it then 50% at $8,000, 50% at $2,000. So think about expected values that we did last time. Last week we talked about expected values with respect to bonds. So the buyer should do the same thing here. according to that logic, you weight this $8,000 at 50%, this $2,000 at 50%. So the buyer's going to say the car's probably worth $5,000. That would be our naive way to approach this problem. What happens next? So the buyer says car's worth $5,000. Say the buyer makes an offer for $5,000. What happens? Which seller is going to accept that $5,000 offer? Here's the problem, right? The seller is not going to take the offer if the seller maintained the car well. If the seller maintained the car, then it's worth $6,000 to the seller. The buyer only offered $5,000. So this seller here is not going to sell. The only seller who's going to be happy to trade at $5,000 is a seller who didn't do the maintenance on the car. Right? The seller here only values the car at $1,000. The buyer's offering $5,000, so that's perfect. That seller of the badly maintained car is going to sell and make a lot of money. The buyer is going to be losing. The buyer is going to be paying $5,000 for a car that's only worth $2,000 to him. Okay, so that's the breakdown. There should be gains from trade, but it's not going to happen. What the buyer's going to do is the buyer's not going to do his expected value anymore. The buyer's just going to resign himself to buying the poorly maintained car. The buyer's going to offer $2,000, and then they know that only the seller of the poorly maintained car is going to accept it, and that's it. You just kind of resign yourself to getting this outcome here. Okay, so NPV doesn't work when there's this private information problem. What does that tell us? Well, if we can reduce the amount of private information somehow, then maybe we can reduce the problem. Right? So NPV is not going to do it enough. Maybe we need some other metric that reduces this problem, and maybe that can create value. So keep that in your mind. That's where we're going. We need some other metric to help us. Okay. The next problem is agency. So agency is related to this information problem, but it builds on it. It builds on these conflicts of interest. Sometimes what one party doesn't want to do what the other party wants to do. So there's a lot of text here. Just show you a figure here. So suppose you're an investor and you want to put money with a venture capitalist. So what do venture capitalists do? Well, they raise a fund. So on the x-axis here, we have the size of the fund that the VC is raising. They're raising funds, and what they're doing is they're finding startups to invest in. So if you think about Google or Facebook or HP, all these kind of big tech companies now, they all started with VC funding. So VCs are hunting for opportunities like that, hunting for small companies that are going to turn into the next Google. Okay, first thing they do is they raise money, and then they go looking for projects. Now, the agency problem shows up when VCs maybe don't look so hard, okay, or maybe they don't work so hard with the money that they're given. Okay, so this is what I'm drawing with these two lines here. The red line is a good VC. This VC can find lots of good deals. So if you think about the size of the fund, and on the y-axis, we have value creation as a function of how big the fund is. If you're a good VC, if you raise a $30 million fund, say, or whatever, $30 fund, you can create $10 in value, $10 in NPV. If you're good, you can keep finding more deals, So if you have a $60 fund, you can raise $17 in value. You can create $17 from a $60 fund. Okay. What if you're a bad VC? What if you're not as talented? Well, you can probably still find some good deals up to a point. So for the bad VC, that's the green dotted and dashed line here. You can still create about $10 million in value if you're given $30 to begin with. But beyond that, you just can't find good deals anymore. So what happens is you start destroying value. Maybe you take too many extra trips. Maybe you overpay for like the hottest startup. You pay too much money for a small share in TikTok or something like that. And that's a way that a VC can waste the investor's money. Okay, so at some point, they stop creating value and they start destroying value by looking after their own interests. They don't have the same incentives as what the investors would want. The VCs kind of doing what they want to do and destroying some value. Okay. Now the problem, like before, is that an investor doesn't know who's the good VC and who's the bad VC, right? It's very hard to tell who's going to have access to all these good deals and who's going to kind of throw in the towel after they stop finding good deals. Okay, so the investors don't know. So just like before, the investors have to guess. So let's say half the time VCs are good, half the time VCs start to waste your money. Well, in that case, this dotted blue line gives you what the investors expect. So from the investor's perspective, all they can care about is this blue line. What are they going to do? Well, they basically have to give everyone just that 30 million, right? They're trying to maximize this dotted blue line. That's what creates the most value for the investors. So this line peaks at 30 because everyone can find some good deals. Okay, but then after that, the bad VCs start destroying value faster than the good VCs can create value, right? It's a lot easier to destroy value than create value. So at that point, the investors' investment goes down. And so investors are going to decide, okay, I'm just going to give everybody 30. I'm going to give good VCs and bad VCs 30. I can't tell them apart. I'm going to give them all 30. That's the best thing for me. Okay. Now this is a problem for NPV because now you can't fund all the good investments. Think about things from the good VC's perspective here. This good VC can find lots of good investments and keep creating value, but they're limited. They're only given 30, despite being able to find lots of good deals. So the good VC has to know that and has to be able to ration their fund. They have to be able to ration their war chest a bit and only take the absolute best projects, right? Not all the NPV positive projects. All right. So the VCs are going to need to have some other way beyond just NPV to choose projects. That's the punchline here. So again, keep that in the back of your head. We're going to come back to that. What else can you do beyond NPV if your funds are limited? Okay. The next friction we talked about information. We talked about conflicts of interest. Now bankruptcy. Okay. So in a perfect world where financial markets are working well, if you go into bankruptcy, then the company can just be transferred over to the bank and the bank can run things without any problem. Okay, now that's not quite realistic. Okay, so let's think about this in a very simple example. You're a real estate firm, you've got $100 in cash, okay, and you can't raise any more money. That's the violation here. You can't raise money for good projects. The firm has a good investment. You put that $100, you make the $100 outlay today, and you get $120 in 2 years with a discount rate of 0%. So that's an NPV of 20, right? If you follow the NPV rule, you should do this. No brainer. Alternatively, there's a myopic option where you just keep the $100 in the bank and you get $102 in a year. So you get to NPV of 2. Okay, so this is obviously less good than the first bullet point. Okay, what's the wrinkle? We're going to introduce this bankruptcy wrinkle. The firm has debt and they have to make a payment on the debt of $100. Okay, so if you don't have the $100 in a year, what are you going to have to do? Well, you're going to have to sell something. You're going to have to sell, say, a building at a fire sale price. You're going to have to rush to sell something. If you have to rush to sell it, you're going to be selling at a low price, so you're going to lose $30 on that sale. So what is the firm going to do? Well, they should take this $20 project, NPV of $20. But if they take this, then they're not going to have enough cash on hand. This project only pays off in 2 years, so they're not going to have the $100 that they need to pay the bank in a year. So they get NPV of 20 here, but they lose NPV of 30 here because of these bankruptcy costs. So on net, that's a bad deal, right? They're losing $10. So what's the company going to do instead? Well, they're going to take this very boring project, just put the money in the bank, earn a little bit of NPV, but at least they have money in the bank to so they can pay off their debt at time 1. And so at least they're not going to lose a 30. Okay, so again, here it's kind of a very silly example. If you're worried about bankruptcy and you're worried about costs that imposes, then you may not take the best NPV project. Okay. You need some other way to help you think about that to make sure that you have enough money on hand. Okay. So sometimes you want to prioritize projects that pay back quickly, even if the NPV is lower. So again, keep that in your mind. We're going to encounter metrics like that going forward. Okay. Final violation we want to talk about, where NPV is not going to be enough, is noisy prices. We said in order to raise money, the price has to be right. right? If the price is wrong, if the price is too low, then Jane Fonda is not going to be able to sell her shares at a good price, and therefore just maximizing NPV is not necessarily the best thing for her. We think about another situation with discount rates. So if you want to apply NPV, you need to have a discount rate, right? You need to discount cash flows by your rate. Now, if asset prices are a bit noisy, it can be hard to know what the right discount rate is. You don't know what the expected return is on something like land, for example. So in this case, you're going to develop some land in Bailey's Prairie, Texas. It's like halfway between Houston and Galveston. You think that land is very cheap. You buy it now, and in 40 years, you're going to make a huge profit off of it. Okay, so you buy the land for $10. You sell it in 40 years for $5,000. What's the NPV? Well, that's a pretty straightforward problem. You get an NPV of about 3. Okay. If your discount rate is 16%. So just 2 cash flows, $10 outlay today, $5,000 inflow in 40 years at a discount rate of 16%, you get an NPV of 3. So for a $10 investment, an NPV of 3 is very good, right? So you should take this deal if you just look at NPV. However, because the asset markets aren't, they're a little bit noisy, you're not exactly sure what the right discount rate is. You're not exactly sure what risk you're taking when you buy this piece of land, right? There's not a whole lot of data to work with. So what would be the NPV if your discount rate is slightly higher? Say your discount rate is only 18%, or it's 18% instead of 16%. What would be the NPV? Well, you can do the same calculation, and you'll get a -3. Okay, so your NPV completely flipped from a +3 to a -3 based on just a 2% change in your discount rate. So this should make you a little bit nervous now, because if you don't know exactly what your discount rate is, something that could look good from an NPV perspective, but be wrong if your inputs are a little bit wrong. So an implication here is that you want to have a robust estimate of NPV. You want to have some way, some diagnostic to tell you whether NPV is robust. In this case, it is not robust. A small change in R leads to a big change in NPV. So keep that in the back of your head. We need to have some measure that tells us whether the NPV calculation is robust to small changes in the discount rate. Okay. With all these problems in mind, we're going to now introduce some complementary measures that we can add to NPV to give us a better picture of whether a project is good. We're going to talk about 4 metrics to try to help NPV out. We're going to talk about the payback period, the average accounting return, the internal rate of return, and the profitability index. We're going to talk about how each one of these can fill in a particular gap that NPV misses. First, we'll talk about the payback period. It's the simplest measure you can think about. It's simply asking, how long does it take for a project to pay back the initial investment? All you're doing is calculating a running sum. So you've got outflows for the project, and then later on, cash comes in. And all you're doing is keeping a running sum of all the cash flows. And when that sum turns positive, that's your payback period. So we'll illustrate the payback period with an example, and then we'll come back to the pros and the cons of the payback period. So here we've got 3 projects, A, B, and C, and we've got the following cash flows. We've got cash flows at time 0, cash flow at time 1, time 2, and time 3. So project A has an outlay of 2,000 at time 0, then 500 inflow, 500 inflow, 5,000 inflow at time 3. Project B also has 2,000 outflow. All projects A, B, and C have that initial $2,000 outflow. Project B has $500 at time 1, 1,800 at time 2. Project C has 1,800 at time 1, 500 at time 2. Okay, so suppose you're using the payback period and you have some rule that says, I'm only going to take projects that have a payback period of 2 years or less. Well, which of these 3 projects would you take? Well, what's the payback period for project A? You start off with negative $2,000. At time 1, you add 500. So now you're still negative 1,500. You haven't crossed 0 yet. Time 2, you add another $500. So you've got minus 2,000 plus 500 plus 500. Now you're still at negative 1,000. So you're still below 0. You haven't paid back that initial investment yet. Finally, at time 3, you get $5,000. And that's what pushes you over the threshold. Now you've collected a positive $6,000, you only put in $2,000, so you've earned back, you've recouped your initial investment, therefore your payback period is 3. Okay, so if your rule is I'm only going to take projects with a payback period of 2 years or less, then you would not take project A. Let's do this for B and C. Well, in both of these cases, you put $2,000 at time 0. At time 1, you haven't recouped $2,000 yet. At B, you've recouped 500. C, you've recouped 1,800. At time 2, then you cross the threshold in both cases. In project B, you've collected 2,300 positive cash flows minus 2,000 negative. So now you're in the black. So you've paid back your initial investment at time 2, and same thing with project C. Okay, so it's very simple. That's one pro. If we go back to the pros of payback period, everyone can do this. You don't need a business degree. Everyone kind of understands this, and you sometimes see products marketed like this. If you think about home improvement projects like substituting all of your light bulbs with LED light bulbs, it's often pitched like that. You can pay back your investments. You pay more for the LED lights, but it pays for itself within a year or 2 because now you buy less light bulbs, something like that, right? So this is a very intuitive measure. It's very simple. Now, what are some major drawbacks? However, we can see it with this figure. Let's just take the simple case of comparing B and C. Well, they both had a payback period of 2, but B and C are not equal for time value of money reasons, right? The project C dominates project B. The cash flows are the same for B and C, but with C, you get that $1,800 first and the $500 later, whereas in B, you get the $500 first and the $1,800. Well, we'd much rather get the big positive cash flow first. That's just basic time value of money. So C is going to be better than B, but payback period treats them the same. Okay. If you had to guess, you could probably figure out which of these 3 projects has the best NPV. Well, if you have a 10% discount rate, you can work through it. It's an easy calculation. A is going to have the highest NPV. Right? A is going to dominate B and C, but A has the worst payback period. So if you're strictly following the payback period, you're ignoring a lot of time value of money. A is going to be best, but you wouldn't take it. Okay. So there's the timing that payback period is missing. There's also the risk that payback period is missing. There's no adjustment for how risky these cash flows are. Usually we would like to account for riskiness using the discount rates here, but payback period doesn't have any way to do that. So it's missing the time value of money, it's missing the risk of the cash flows as well. The benefits are it's simple, but let's think a little bit more deeply about this. Why would a sophisticated, MBA CEO use the payback period? If we go back to all of the problems with NPV, all the assumptions that you're making, NPV works well if you can raise money for good projects. And we saw there's a bunch of reasons why it may be hard to raise money. If there's conflicts of interest or information problems or bankruptcy problems, it may be hard to raise money for new projects. Well, what could you do then if you can't raise new money? Well, you just have to finance things using the cash that you have. That's your only option, then the payback period may be very helpful, may be beneficial, because the faster you get the money back, the faster you can put it into new projects. Right? If you can just raise money whenever you want to for good projects, then payback period doesn't make a lot of sense. Okay, because it ignores time value of money and all these things. If you can raise money easily, you probably shouldn't use payback period. But if it's very hard to raise money, then you want to make sure that you've got some cash for when a good project comes along. Okay? And so that would be the more sophisticated reason why you'd want to use the payback period. That, I think, in the spirit of this lecture, that's the best reason to use payback period, because NPV is gonna not do a great job if you can't just raise money every time you need it. Payback period is going to help you a bit there. The next measure is called the average accounting return rule. What this measure is doing is it's all based on accounting numbers. You calculate the net income for a project. You average that over the life of the project. You average the book value of the investment over the life of the project, and then you take the ratio and you say, you need this ratio to be above some thresholds. You need your income to be high enough relative to your investment in order to take the project. So let's put some numbers on it. Suppose you're going to buy a new truck. Okay, the truck costs $50,000. So we'll get into accounting more next week, but if you buy something like a truck, it depreciates over time. Okay, so you buy it for $5,000. At time one, say it's only worth $40,000. You know, as soon as you drive a car off the lot, we say it, it loses value. That's what we do in accounting too. We drop the value of assets like that over time. So if this is straight line depreciated, the book value looks like this: 40, then 30, then 20, then 10, and then it's depreciated all the way to 0 at time 5. Okay. How much income is this new investment generating? Well, suppose it's generating $5,000 per year because it lets you take extra jobs or do jobs faster so you can take extra jobs. So you're getting an extra $5,000 each year, 1, 2, 3, 4, and 5 for the life of the project. How do we apply the average accounting rule, average accounting return? We calculate the average of the income divided by the average book value. So what's the income? It's $5,000 every year. Take an average of that. That's easy. It's $5,000. So that goes in the numerator. What's the average book value of the truck, of the investment? It's $4,000 here, $30,000 here. So you average these 5 numbers and you get $20,000. And that gives us an average accounting return of 25%. Okay. And so you have some rule, the company has some rule, says, is this high enough? Is this net income relative to our investment high enough? If so, then take the project. So now that we know what it is, let's talk about some of the pros and the cons. Talk about the cons first. What's different here, the main thing that sticks out right in the name, is that we're using accounting numbers. Everything else we've done so far in this class is about cash flows. We have cash flows, we discount them to get the present value. Now all of a sudden, we're talking about accounting. Okay. That's a problem because economically, you don't care about accounting by itself, right? Investors don't care about income by itself. Investors care about cash. You can't go to the store and buy groceries with income, right? You need cash. That's the important thing. You can't pay back your loans with income. You need cash. So that creates a bit of a distortion. If we're using accounting numbers that are not cash flows, we've created a wedge between what we're measuring and what we ultimately care about. So that's one problem. A second problem, like payback period, the AAR is doing a bad job with time value of money. We look at this example again. We're averaging everything over 5 years together. We're averaging all the income for 5 years. But economically, you care a lot whether the income happens at time 1 or at time 5. Right? You'd get the same average net income if you put this $25,000, you put all that $25,000, if you put it all at time 1, you'd get the same AAR as if you spread it out over 5 years. So, okay, so it's not doing great with time value of money either. Another way to see this is when you buy a truck, you put the $50,000, you pay money today, right? And it's kind of missing that. It's missing the timing of the cash flows and the amount of the cash flows. And obviously, again, there's no sense of risk here. Just like with payback period, there's no discount rates where we're trying to incorporate the risk of this net income. We're just completely missing that. So those are the obvious cons. What are the pros? Well, again, if we think about the problems with NPV, why do we need extra stuff beyond NPV? A big problem shows up with information. The managers of the company know a lot more than investors, and that makes investors worried. That means that investors are not going to give money to the company when the company needs it, because investors don't really know what's going on, and so they're not going to just trust the CEO. They need to have some extra data. That's all accounting is. That's the fundamental purpose of accounting numbers, is to convey that information to your investors and to try to alleviate those frictions. So investors are looking at these things, right? They're looking at your net income and the book value of your investments. And these things, if they don't look good to the investors, then the company may have problems raising money. So what this measure is doing is it's trying to look good to the investors, trying to show the investors that you're doing the right thing, trying to alleviate some of their fears about what's going on in the company. So again, this is addressing that NPV shortcoming. NPV says if investors don't fund good projects, then NPV is not going to work very well. This measure is trying to convince investors to fund your projects. Sometimes these accounting numbers will be written directly into the contracts with your investors. The clearest case of this is with loans. So a bank, for example, will have covenants on their loan. They say you have to keep your income minus your investments. So these two things, you have to keep your income minus your investments high enough to pay your debt. Okay? And if that number falls, if your income gets too low relative to your debt, then you may be considered in default, and the bank can come and force you to pay the debt right away or to come in and take over. Right? So investors care about these numbers. Accounting numbers are very important for investors, and for that reason, companies may care about a measure like this to try to convey that information to investors. Okay, so that's a pro. It's trying to get those information problems that are such an issue for NPV. The next measure is the IRR, the internal rate of return. The definition here, the IRR is the discount rate that sets NPV to 0. It's called the break-even point. If the IRR is higher, it's the point at which NPV is equal to 0, so that's why we call it break even. You're breaking even here, right at NPV equal to 0. And so a company will set an acceptance criterion, just like you have a criteria for payback period or AAR. Here you accept an IRR, you accept the project if its IRR exceeds your cost of capital. So let's just make sure we understand the math here. Here's a simple example. You pay $4,000 for a machine, and then it's going to generate $2,000 in a year and $4,000 in 2 years. So you've got 3 cash flows, $4,000 today, $2,000 in a year, $4,000 in 2 years. How would you go about getting the IRR? Well, you've got 3 cash flows. You set the NPV to 0, and you solve for the rate. Okay, so here's the NPV of those 3 cash flows, minus 4,000 today, 2,000 in a year, 4,000 in 2 years. You got the timing of the cash flows. You just need the discount rate such that the NPV is equal to 0. And then you solve for the IRR. We already saw this with yield to maturity. We can translate this example to a bond. So suppose we have a bond that costs $4,000 today. So you buy the bond, you pay $4,000. That's an outlay of $4,000. You've got a coupon of, say, $2,000 at time 1, coupon of $2,000 at time 2, and like a face payment, principal payment of $2,000 at time 2 as well. That would replicate these cash flows. And then the yield to maturity would be the rate that sets the NPV to 0. Okay, the yield to maturity is the thing that reconciles the price with these promised cash flows. And so the math of a yield to maturity is the exact same as the math of an IRR. Like we saw with yield to maturity, it's not trivial to solve this thing. So I would not ask you to solve for IRR for this example, because you have a nonlinear equation here. You'd have to solve for IRR squared terms, and that's not an easy thing to do. You could conceivably solve for IRR if you have just 2 cash flows. So this would be the 0 coupon bond. You could solve for the yield to maturity with a 0 coupon bond because you only have 2 cash flows to worry about. Likewise, you could solve for the IRR if you just have 2 cash flows to worry about. But if you have 3 cash flows like here, then I'm not going to ask you to solve for the IRR. You would need some kind of a computer to do that. So you could use a financial calculator. You could use Excel. We talked about goal seek to find the yield to maturity. You could do the same, use the same procedure to find the IRR. So let's think about the pros and the cons of the IRR. We'll talk about cons first, because that's what we've been doing. It's a little bit easier to think about the cons. One con is that the IRR misses scale. So if you think about an investment that pays say it costs $1 today and it pays off $10 in a year. $1 today for $10 in a year. Compare that to an investment that costs $1 million today and pays off $10 million in a year. What's going to be the IRR for these investments? It's going to be the exact same, right? Whether it's minus $1, positive $10, or minus $1 million, positive $10 million, you're going to get the same exact IRR. Okay, so here's a case where NPV is going to help us a bit, because NPV is going to give us a much different answer if we're talking about $10 versus $10 million. Okay, you don't want to bother your boss for a huge IRR project that has a very low NPV. Let's put it that way. All right, so that's one con of the IRR. The other con is that sometimes you can get multiple IRRs, and it's not really clear what to do with that. Why does that happen? Well, again, you're solving a nonlinear equation. Here we've got a squared term. If you remember what a function looks like, if you think back to algebra, what does a function look like if it has a squared term? It's going to be curved. Okay, so there may be multiple answers that solve this equation. And you can just see this with some examples. So here's just a stream of cash flows. You put in $1,000 today, you get $800 at 150, 150, 150, 150, minus 150. You can check this. You can get two separate IRRs that set the NPV here to 0. An IRR of 15.2 works, an IRR of minus 50% also works. Now, what do you do with this? It's really not clear, because suppose your cost of capital is 10%. Well, that means that you need your projects to earn more than 10% to be a good deal. If the IRR is 15%, then that works. Right, you should take the project because you're earning 15%. Your cost of capital is 10, so you're doing better than your cost. Right, so take the project if your IRR is 15. However, if your IRR is minus 50, then you're definitely not earning the 10% that you need. So you should not take the project. Right, so that's why economically this becomes a big problem, because with this IRR, take the project. With this IRR, don't take the project. Mathematically, you can't really distinguish. Well, why should you say one IRR is better than the other? You can't. So it's a little bit unappealing there. If you want to see this in a picture, you can draw out the discount rates on the x-axis and the NPV on the y-axis for this project, and you see that the NPV hits 0 twice. Intuitively, what's going on is that we've got two negative cash flows. The cash flows are alternating between negative here, positive here, and then negative over here. And so what the 15% IRR is doing is it's putting more weight on the later cash flows. With the minus 50% IRR, it's putting more weight on the earlier cash flows, and you can find discount rates. If you put enough weight on this negative cash flow, you get a certain IRR. If you put enough weight on this later negative cash flow, you get a separate IRR, right? And so it's not something you can explain to your boss, right, or to your investors to say, why would you choose one rather than the other? Okay, so those are the cons of the IRR. We have scale, and we have this possibility for multiple IRRs. Okay. Kind of side note, with yield to maturities, you can't get multiple yield to maturities. Why? Because the cash flows don't alternate. You have one negative cash flow when you buy the bond, and then the bond pays off all positive cash flows after that. So you only get one yield to maturity. But here, if the cash flows alternate signs, you can get multiple. Okay, so that's just something to bring it back to the yield to maturity. So what's the benefit of doing IRR? Well, one nice thing that you can tell right away is it looks like NPV, right? You're building off of the NPV calculation. So that means that IRR is going to do a good job at dealing with time value of money, right? We're discounting cash flows that go into the future, which is good. And it's also going to do a good job at thinking about risk, because you can think about your cost of capital, which is based on the risk of the investment, and you can compare that to the IRR. So it's going to do fine there. It's going to do much better than the payback period or the accounting return when it comes to time value of money and risk of the cash flows. But why do we need IRR beyond NPV? Why not just use NPV? IRR is a useful diagnostic for NPV. So what do I mean by that? Think about the example where you bought a small plot of land that paid off far into the future. And we saw that small changes in your discount rate can affect the NPV by a lot. You can completely flip a positive NPV project to a negative NPV by an equal amount. It becomes equally negative as it was positive before with a small change in the discount rate. Well, the IRR is a way to convey that information. If the IRR is very close to your cost of capital, then you should be worried. Because if you're not confident in your cost of capital and the IRR is, say, just a little bit above your cost of capital, then the project could become bad, right? If your cost of capital is lower than what it should be, then maybe it's actually a bad project and you just put in a slightly low cost of capital. The IRR tells you that basically right away. So you can decide if the IRR needs to be kind of well enough above your cost of capital to take the project to be safe. Right? Otherwise, maybe you wait a little bit and you don't take the project. If the IRR is right at your cost of capital, then maybe you don't take the project and you maybe dig deeper or something into the numbers. So I view that as the main pro. It helps give us a sense of how close the NPV is to zero, right? How much flexibility do we have with our discount rate before what looks like a good project turns into a bad project? The last measure I want to talk about is called the profitability index. So profitability index is also going to be based on NPV, just like IRR was building off of NPV, so is the profitability index. The idea with the profitability index, though, is that you only have a limited budget. Remember, with the NPV rule, you take as many projects as you can, as long as they're positive NPV. With the profitability index, you have a fixed investment budget, and you can't go beyond that. And so what do you want to do? You want to maximize the amount of NPV subject to this constraint. Okay? So you're dividing NPV by your investment. You want to try to maximize this ratio. Okay. So let's consider these investments. You're the CFO of a company and you're limited, right? You can only invest $300,000. That's the constraint. You've got these four options. Notice that they're all positive NPV. So you would want to take all of them if you could. That would be the best thing for your investors. But you only have $3,000 to invest. Each of these investments costs a different amount. Okay. So what would you do to maximize NPV subject to this constraint? Well, you'd want to look at all the different combinations of projects. What is feasible? Think of all the combinations of feasible projects, and then find the one that has the highest NPV. So if you take project A, you have to spend $200,000. You only have $300,000, so that's all you can do. You can't take any of these other projects if you take project A. So your NPV would be 230, and that's it. If you take project B, then you could combine it with project C or project D. You couldn't lump all three of them together, that would exceed 300,000, but you could combine, say, B and C. And if you combine B and C, then you would get the NPV of those two combined would be 141 plus the 194. Or you could combine B and D, and you would get an NPV of 141 and 162 together. Okay. So you have to work through all these different combinations. Okay, so it's kind of an intuitive idea. You only have so much to invest. Just find the combination that give you the highest NPV. So in this case, you can probably just see right away what's the best thing to do. You're going to want to invest in B and C together. B and C is giving you the full $300,000 investment. You're using everything you can. You're not leaving anything on the table, and it gives you the NPV of, about 320, which is higher than if you invest in, say, B and D, which would also be feasible, but B and D would only give you about 300,000 instead of about the 320 NPV. Okay, so this is the weighted average profitability index for all these different combinations of projects. We see B and C gives you the best combination. So the last part of this lecture, I want to talk about what do CFOs actually do. So this was about 20 years ago. A couple academics, John Graham and Campbell Harvey, they sent out CFOs to all the Fortune 500 companies, and they asked them how do they make these decisions. They had about 392 responses on these 100 questions. And this is a tabulation of the results. So each row here is a different method that companies can use, that CFOs can use to make decisions. And then on the x-axis, we have the percent of CFOs who mostly always use the technique. So we see right away IRR and NPV are very popular. 75% of CFOs are always using these two. So that's good. They're worried about time value of money, and they're thinking about the risk of the projects. So that's good. What may be a little bit more surprising, however, is that almost 60% are using the payback period. We saw payback period is very simple, pretty naive, really, but 60% of CFOs are almost always using it. So what does that tell us? That should tell us the NPV is not enough by itself, right? There are frictions. There are problems with raising money, so CFOs want to get money back so that they can then reinvest it in good projects. That's kind of the most rational reason why you'd want to use the payback period. Okay. Some are using the accounting return, the book rate of return, 20%. So this doesn't seem to be as important to them, but still 20% of the Fortune 500 is a lot. Profitability indexes seems to be less valuable, 12%. Okay. So bottom line, who is using NPV? Well, a lot are, but they're particularly using it if they're large, if they're publicly traded, so they're trading on the New York Stock Exchange, for example. If they have a lot of debt, so if they can raise debt pretty easily, then they're using NPV or IRR. Related to that, if they're utilities, so utilities are very stable companies that have an easy time raising money. And finally, if the CEOs have MBAs, then they're also using the NPV or the IRR. So taken together, what does this mean? Well, for these companies, they probably have a reasonable time raising money. They can probably raise money at a fair price because they're publicly traded already. They already have access to the debt markets because they're pretty stable. All of these companies are going to have access to new funds when they get a new project. And so if that's the world we're living in, then we said NPV is great. Okay. Why are 60% using the payback period? Well, it must be that 60% are suffering some kind of financial constraint. They can't finance everything that they want. And because of that, the payback period is a useful metric to tell them how quickly they can get the money back and invest in new projects. Okay. So this is just a punchline. Why not just use NPV? There has to be some problem in the markets. So for example, if you can't raise money for a variety of reasons, then payback period looks good. If investors don't really trust you and you need to convey information to them, then you may think about some accounting-based metric. If you're not sure what your cost of capital is, then the IRR gives you a useful diagnostic. You can tell right away if things are kind of too close to call or if your project is safely above your cost of capital. And if you only have a fixed amount to invest, then the profitability index can help you get the best bang for your buck. As a final note, I don't think these are things that you should use in place of NPV. NPV is still going to be valuable because it accounts for risk and time value of money, but you can use these things in addition to the NPV.